Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
John Mauldin publishes Thoughts from the Frontline. It's the most widely read investment newsletter in the world. You've probably seen him on CNBC and Bloomberg TV. His most recent book, Endgame, The End of the Debt Supercycle and How It Changes Everything. Visit John at MauldinEconomics.com. Hey, John, welcome to This Week in Money.
It's always good to be with you.
Right at the very beginning of the book, John, you talk about the roots of the current financial crisis. Basically simple, we've been acting like teenagers. We've made some dumb choices, and now here we are dealing with the consequences, just like teenagers would.
We are, and just like teenagers, we're not thinking that much of the future. We're only thinking of our current experience. And the long-term consequences just keep adding up. In essence, this generation is taking benefits and healthcare, Social Security, and they're expecting the future generations to pay for it. The problem is there's going to be fewer people paying for more people in retirement. And that's a business model that just doesn't work.
John, the word sequester seems to be on our minds a lot this week, and it's pretty much a poster child for monetary policy up to this point. How did we get here, and where the heck do we go now?
Well, I mean, we got here because everybody said, well, we've got to cut the budget, and so we'll just agree on an across-the-board cuts. Because, of course, nobody could actually believe that they wouldn't rejigger it or rework it when you finally got down to the end day, which is exactly what we got to. And, in fact, they couldn't agree on what to do. So we're going to have these cuts. Now, the cuts are a good thing. The way we're going about and doing the cuts is stupid. We should allow the managers in the Defense Department and the various agencies to decide what's more important rather than just doing across-the-board cuts in agencies, some of which are more important than others. I mean, the air traffic controllers are a great deal more important than funding some sidewalks in California.
Sure.
Or park roads that don't exist in Alaska. I mean, not that those might not be worthy projects, but I mean, when you're having, like any family, when you're on a budget, you have to decide what your priorities are. And we should allow the managers, whether you like them or not, whether you think that you can trust bureaucrats or not, they're the closest to the problem, and they should be able to help determine, with congressional oversight, what we do. But that's not what we're doing, so we're going to get cuts. Then we come to the end of this month, and we get the debt ceiling, and you have to do an ongoing continuing resolution. And the new baseline, if you will, from the Republican standpoint is lower. In one sense, they're better off just doing it this way, I guess, if you're trying to think of the longer-term picture. But, it just seems so dysfunctional.
Have we done a good job, John, of deciding what the priorities are, or have we done just a really lousy job here?
Well, we've done a lousy job, at least from my perspective. I mean, we're spending money on a lot of things that we, in fact, probably could get away. I mean, they're nice things to do in most cases, but it's just a matter of ranking priorities. And we have a limited budget. We have decided that we want to provide universal health care, and that's going to have a cost and a consequence.
Yeah.
I'm worried in 2014, when the real costs begin to become manifest, that it's going to be a more significant drag on the economy than anybody thinks, because it's going to change the incentive structure, not only in the healthcare industry, but in the business as a whole. I mean, there are certain circumstances where for, say, a lower wage earner in the $15 an hour range, that he's paying for half his health care and splitting it with his employer, and then he's picking up his family. He is better off if the employer dumps him onto the system, because that means his family now qualifies for full health care benefits, whereas if he has access to it through his employer, he has to pay for it. So you get this perverse thing where a worker goes to his boss and his employer and says, just give me some extra money and cut me from health care. And then let's dump me onto the system, which is going to cost a great deal more in the aggregate to the system. And the rational thing for to do for both the employer and the employee is to not have employer-provided health care. And moving that money around in the 50,000-foot picture, it's the same. We're moving money from here to over there. But the plumbing to do that is going to show a massive gaping budget hole in the federal budget and the state budgets, that we don't have any way to move that money from the employer and the employee over there yet. There's no mechanism to do that. And it's going to create budget crises. It's going to create deficits. And the crisis that we think we're dealing with now with the sequester and the debt ceiling becomes massively more. And I think it has the potential to be the trigger to push us into a recession if we're still in a slow-growth economy. These things worry me. And it's not that I can make a model for it. We can't. What we're doing is messing around with human nature and incentives. And there's no model for that I can say, okay, if we do 10% of this and this changes, things change. I don't know how that works. It's very disconcerting to me.
Great quote here from David Walker, former U.S. Comptroller General. John, we're here because of a failure of the president, a failure of the Senate, and a failure of the House. He says it's a global embarrassment.
Well, it is. I mean, the Senate hasn't passed a budget in something like 1,000 days or something. And constitutionally, they're supposed to do that. I mean, they're just completely ignoring it. I mean, they haven't passed a major bill in 900 days. The level of dysfunctionality there is amazing. Obama is not giving us any leadership at all, which is a problem. The only budget that he's offered has been one that got no votes in either the Senate or the House from his party. That's not a budget. That's a wish list. That's a Christmas tree.
Yeah.
If you had a serious budget, you'd think it would garner at least a few votes. This dysfunctionality will end, and it will end in tears if we don't come together, and the self-serving needs of politicians to not completely put the system in crisis doesn't override their destructiveness.
John Mauldin from MauldinEconomics.com, our guest here on This Week in Money. John Stewart this week pointing out the contrast between our lousy economy and the fact that the major indexes are near all-time highs. Is there a disconnect of some kind going on here?
Well, I have written a lot about this. There is always a disconnect between the emotions of people, investors, and the underlying reality. There are people out there who talk about, well, the market is telling us this or that. And I reply, the market doesn't know jack. It's not telling us jack. What it's telling us is where the latest emotions of people and where the momentum's going. When the markets were reaching new highs in 2007, were they telling us the economy was fine and there was not going to be a subprime crisis? Well, the market didn't know. The market doesn't know anything now. All it sees is the momentum, and things are moving up, so people are crowding in. And the day will come when, oh my goodness, it's not working, and they all start going out, and then you get a bear market. The correlation between how well the stock market does and what the economy is doing is not very high over short-term periods of time. Over decades, it's very, very close, but not over short-term periods of time. So to look at the market to try to get a feeling for what the economy does, of course there's a disconnect, always has been.
Let's talk about the underlying reality here, John. You were mentioning that a second ago. Uncle Sam's unfunded liabilities, Medicare, Social Security. How big is the bill here, and when's it come due?
Well, it starts coming due next year with Obamacare, and all over the next two or three decades. The bill is, Scott Burns and Kotlakoff are estimating it like $200 trillion. It's a bill that can't be paid. So, I don't worry about it. We just can't pay $200 trillion. Not going to happen. The far more interesting question is what happens when we realize we can't pay it, and what happens when we realize we have to restructure it. and there will be winners and losers, and there's going to be a lot of weeping and wailing and gnashing of teeth. And benefits are going to get cut and taxes are going to get raised. I think that's the ultimate solution. Is we're going to have to reduce the cost in the systems, and that means the doctors and the healthcare workers, the medical service providers, the medical equipment providers are going to get less money. They're going to see their income squeezed. That's just what has to happen. There's X amount of dollars that can go into the system, and they haven't really had any major cost containment yet. Most of the hospitals are barely running on workable margins. We have too many hospitals in a lot of areas, and we're going to have to see those go away. In some areas, we don't have enough. It's not a rational market-driven system in the classic sense of free markets. And that if we're not going to have a free market system, then we're going to have more of a regulated system that maybe treats healthcare like a utility, like we do electricity or water, where we mandate margins and so forth. So some way it's going to have to be changed. My guess is it's not going to be changed the way that I would like to do it. It's going to end up being compromises and a kludge, but it cannot continue the way it is.
John, you've pointed out in the book that there are no easy fixes, no easy choices. In order for us to stop being teenagers here, what choices do we have to make in the next while?
From an investor standpoint?
Yeah.
I think right now you want to be somewhat cautious. I mean, your long-term stuff, you want to be long what central banks can't print. They can't print real estate and agricultural land. They can't print new technology. They can't print food. They can't print commodities. They can't print a host of number of businesses that are important to the survival of the basic commerce of human social structure. So we need to think about the implications of massive and continual quantitative easing. We need to think about what happens when central banks start competing with each other to manage their currencies. Even though they're not going to use the word manage their currencies, they're going to use about, well, we're trying to deal with our economy, and it's all internal, and there'll be code words, but it's going to have the same effect. It'll be large misallocations of capital. That creates opportunities for investors, so you want to be cognizant of where that misallocation comes from. It comes from central banks, but where it's going to end up, and take advantage of that, and or get out of the way. Unfortunately, we're in a world where it's not simply supply and demand markets. We have to look at what politicians and central bankers are doing.
John Mauldin publishes Thoughts from the Frontline, the most widely read investment newsletter in the world. Best of all, it's a free subscription. You can find out more info at MauldinEconomics.com. You can also like John on Facebook. Follow him on Twitter at John F. Mauldin. And don't forget, John's at the Wine Country Conference, April 5th in Sonoma, California, with our good friend Mike Shedlock.
It'll be a lot of fun. That conference is going to be great.
Yeah, that's going to be fun. The theme, Investment Ideas for Unconventional Times. More info at winecountryconference.com. Hey, John, thanks so much for talking to us today.
Thank you, sir.
Coming up, John Rubino on This Week in Money.
Always consult your investment professional before making any investment decision. He Touched Me, the Gospel Show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com. This Week in Money is archived online at talkdigitalnetwork.com.
John Rubino is co-author of The Collapse of the Dollar and How to Profit from It. Visit John's website, dollarcollapse.com. It is, and always will be, your ringside seat for the global financial crisis. John, it's good to have you back on This Week in Money.
Hey, Phil, great to be back.
Anybody not talking about the sequester this week is scratching their heads about the Italian election. Check out these results. The left-wing guy, Bersani, 30%. The center-right guy, Mr. Bunga Bunga, Berlusconi, 29%. Look at this. A comedian came in third. A huge protest vote for Beppe Grillo with 25%. What the heck is going on in Italy?
Well, the Italians, what can we say? As an Italian American, I'm reasonably qualified to talk about this without seeming prejudiced, but this is a culture that has been ungovernable from the beginning. You know, there's that old joke about in hell the Italians run the government, and that's reasonably true. You know, this is my people are emotionally immature. You know, we live in the present, and that makes us a lot of fun sometimes, but it makes us also ungovernable. And Italy's been able to get away with this for as long as it has because it's been able to borrow more and more money each year. You know, they've run deficits that are right up there with the worst of the Eurozone, and that's saying something. And now they're reaching the point where they can't borrow any more money, and so they have to behave in an emotionally mature manner, which is to say they have to live within their means. And they really can't do it. I mean, they're just not suited for it emotionally and temperamentally. And so what you're seeing is chaos there, where every election throws out the old guys and brings somebody in new, and the new guy can't keep his promises because there are no fixes that allow the Italians to continue to borrow money with impunity. And in this last election, we didn't even get a new guy. The people who got the most votes can't work a deal out where they form a government with anybody else. So it looks like they're just going to struggle and negotiate, and the negotiations are going to fail, and they'll have to have new elections in another few months, which means in the meantime nothing will get done. There will be no austerity plan or efficiency plan or anything else that would have helped move the economy towards sustainability. So they're just going to pile up more and more debt. In the meantime, they're going to be worse off after the next election, and it's not clear that the next election is going to resolve anything in any event, because for any of the main guys to win, other than the technocrat who only got 10% of the vote, the policies that they're going to bring with them won't work. Either it'll be right-wing populism, which is more of the Berlusconi's government, which already failed, or it'll be left-wing populism, which would install a government which is kind of similar to France's, and France is now imploding. And so there's no real solution. And the rest of the world is kind of Italy writ large, so there's a lesson here. When you borrow too much money, you gradually become more and more ungovernable until you descend into chaos. And Italy is kind of showing the way that the U.S. and a lot of the rest of the world is following, in lockstep.
Now, if this was a place like Slovenia, we could probably laugh this off, but we're talking about Europe's third largest economy here.
Yeah, they've got $1 trillion or so of debt, and a lot of which is owed to big German and French banks. So for Italy to go means the rest of the Eurozone gets pulled down along with it. And so this isn't Greece, 2% of the Eurozone economy. This is a large, more or less modern, highly indebted economy that is intimately intertwined with the rest of the industrialized world. So, yeah, we can't see Italy go and be unscathed. So what will happen is, going forward, the Germans, and to an extent the French, will have no choice but to lean on the European Central Bank to finance as much of Italy's debt as it takes to keep them from imploding, which means, every conversation that you and I have always leads back to the currency war. There's no choice at this level of indebtedness except to monetize the debt by creating a whole bunch of new currency and buying up existing bonds and then flooding the world with that new currency, and in that way lowering the value of the euro or the dollar or the yen, depending on what country we're talking about at any given time, in the hopes of generating some trade advantages which pump up the economy, which pump up taxable income, and which lessens the pressure on government budgets in the short run. But you can't do that in the long run because your trading partners retaliate by pushing down the value of their own currencies, and you get the currency war that we're in right now. So Europe might be the next region to feel compelled to force down the value of its currency. Right now it's Japan that brought in a new leader who is insisting that the Japanese central bank name a 2% inflation target and stick to it by monetizing a lot of debt. And that has pushed down the value of the yen at the expense of the dollar and the euro. And now if Italy is going to teeter close to the edge of the cliff, Europe is going to be forced to force down the value of the euro, and so on. This is something that goes on until you reach the point of global chaos, or everybody goes to the gold standard and just starts over again. So who knows how this plays out, but it's going to be messy along the way.
John, last time you and I talked last year, the Greek exit from the Eurozone was the big theme then. Could we be seeing the same thing with Italy? Is that a possibility they'd leave the Eurozone?
Well, it's technically possible, but they owe so much money to the big banks of the world that for Italy to leave the Eurozone, and then the advantage of leaving the Eurozone is that you get to go back to your old currency and devalue it. So if you go back to the lira, devalue it by 30 or 40%, that means the loans that have been made to Italy by German and French banks are now 30 or 40% less valuable, which means they have to take big write-offs, which will destroy their capital, which will bring them down. So letting Italy leave the Eurozone opens the door to a year of absolute chaos while everything is being sorted out and the big German and French banks are being bailed out and the euro is being forced down to accommodate this. So, it's easier just to do the bailout in the short run up front and monetize a bunch of Italian debt and keep them in the system in that way. So that's more than likely what we'll see. And then the focus shifts to the euro. Does it hold enough of its value to stay a valuable currency, a functional currency, if they do something like that? Or does it fall off the table because everybody loses faith in its future value? And there's no way to know ahead of time, because at some point, that's the fate of all the major fiat currencies of the world, but we just don't know when, and we don't know what the catalyst will be. But, bailing out Italy with $1 trillion extra new euros freshly printed and sent into the market might be the thing that does it.
John Rubino from DollarCollapse.com, our guest here on This Week in Money. We saw a slew of economic data this week. Consumer sentiment up, factory activity in the U.S. up, consumer spending up as well, GDP up slightly. Too soon to tell here if we're in recovery mode. You're posting the latest on the DollarCollapse.com website from the Consumer Metrics Institute. You're saying, as they're saying, we're looking at a hard year ahead here.
Yeah, basically what they're saying is that the third quarter numbers in the U.S. last year implied a nice recovery getting underway. But what really happened was that the U.S. government did a lot of defense spending ahead of time, the defense spending that would have happened this year. They did it all in the third quarter in order to pump up the economy heading into the election. And also, taxes were lower last year than they are this year. So you combine the fact that defense spending is going to fall a bit now to make up for the fact that it was front-loaded last year, and payroll taxes have gone up in the U.S., and you get zero growth going forward. So it looks like we might not be in a recession, but we aren't growing at all either, which isn't adequate to help us pay off our debts or even moderate the $1 trillion a year deficits that we've got going forward. So we're not fixing anything, despite the fact that the government is running massive deficits and has pushed interest rates down to near zero. The economy's not growing. And this is what happens when you borrow too much money, that your debts become a headwind, which force you to put up with either very slow growth and all of the pain that involves, or take even more extreme steps like monetizing even more of your debt or running even bigger deficits going forward, which then destroys your currency eventually. And so in other words, there's no really easy, pain-free way out of a situation where you've borrowed too much money. And that's where we are. So the question now is, how do we respond to zero growth for as far as the eye can see? And without a doubt, we're going to respond with greater ease. The Fed won't be able to end quantitative easing anytime soon. It won't be able to let interest rates go back up to normal levels so savers can generate a reasonable return on their retirement savings. And more than likely, they'll have to increase the amount of debt that they're buying with newly created currency. And still with no end in sight, because as we continue to take on more and more debt, the headwind gets more and more extreme and slows us down even more, other things being equal. So I think we're past the point of no return. There's an Australian economist named Steve Keen who talks about the debt event horizon, the point at which there's no escape. And we're there now in the U.S. We've borrowed more than we can ever hope to pay off, and it's slowing the economy down to a crawl, and we have no solution for this. If we have time, Phil, we could take a step back also and talk about how fraudulent the numbers are that we're seeing in any event.
Absolutely. It's easy for us to be cynical that the government is gaming these numbers, right?
Yeah, and they really are, because other than the fact that they screwed around with the timing of a lot of their spending to make the election year economy look better than it really was, the whole concept of GDP, as we calculate it, is inherently flawed, because it only looks at the income statement, not the balance sheet. In other words, if you have to borrow $1 trillion to get $100 billion worth of growth, you didn't actually have growth. You actually just went deeper into debt in order to stay where you are. But our GDP numbers only show the growth numbers. So if we have moderate, steady growth, they say that we're a healthy economy, or that's the impression that the government gives by only reporting that number. But if we're having to borrow more and more money each year in order to get that 2 or 3 or 4% real GDP growth, then we're actually digging ourselves deeper and deeper into a hole, and that's really what's happening. And we just don't report it. And that's if you just report debt as officially defined. If you take the unfunded liabilities of Medicare and Social Security and all the other pension programs out there, then we're actually digging ourselves into a $5 or $6 trillion deeper hole every year in the U.S., even when we're supposedly showing positive GDP growth. And if people understood this, and I think the whole consumer confidence number and home sales, all the things that they're convincing us to do right now with their fraudulent accounting, that would all change, because people would be a lot more worried than they are today.
How's the market reacting to what's going on, and what do we look at going forward?
Well, the stock market is behaving in a really surprising way, considering that GDP looks like it's flat, and it looks like it should be flat going forward based on the real numbers that are being calculated out there by honest analysts. And so you wouldn't expect the stock market to be hitting all-time highs when the economy is flatlining. So at some point in the coming year, those two contradictory ideas are going to collide. And either the economy will pick back up and start growing faster, and which is possible, although probably not in terms of a balance sheet. We still won't be getting much of a bang for our debt buck, but it could be that the economy picks back up, in which case stock prices might be seen to be justified by for a little while longer, or the economy stays flat, which I think is more likely, and stock prices come to be seen grossly overvalued, because they're assuming steady growth in corporate profits going forward, which you can't get if the economy is flat. So we'll see. But one or the other will happen, and my guess is that it'll be the one that's negative for the stock market.
John Rubino, co-author of The Collapse of the Dollar and How to Profit from It. And you can find John online at dollarcollapse.com. Hey, John, always good to talk to you. Thank you, sir.
Great. Thanks, Phil.
After the break, Dave Skarica on This Week in Money.
He Touched Me, the Gospel Show. Randy Elvis Frisky and his Las Vegas show band. Saturday, March 30th, 2 shows. Kelowna Community Theater. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can visit Dave at addictedtoprofits.net. Hey, Dave, it's good to have you back on This Week in Money.
It's great to be here.
Let's take a look at stock markets. They're flat for the week. The Dow now 1.5 away from its all-time high reached in October 2007. The S&P off less than 5%. Now, if you believe the current bull started March 9th, 2009, we're almost 4 years in. Are we looking at the threshold of another bear market here, Dave? What do we see looking forward?
I don't know if we're in a bear market, going to see a bear market. I definitely think that the market is very, very overbought in the short term, and we're going to hit resistance right now because we're getting back up to those 2007 levels. the top levels, and we're seeing a lot of optimism in most of the sentiment indicators. So I definitely think that we can see at the very least a correction. But topping tends to be a process. Everyone says the market's going to top, and if you look at a lot of these tops like last year, or even in like 2011, et cetera, and these are just corrections. These weren't bear markets. Sometimes it took a number of months for us to top. So I do believe that if we are seeing a short-term top here, it might take till that kind of, sell in May, go away time frame. It might take another month or two for us to top before we see some kind of significant correction in the equity market.
Seems like a lot of the juice in the last little while has come from the Federal Reserve and Chairman Bernanke. He's been all over the news media this week saying that basically the easy money policies are going to continue. What's going on here?
Yeah, I think that, for some reason, I started in the markets in the mid-'90s. Don't worry, I will get to the point here, but I think there's an interesting story to tell.
Sure.
The way psychology of good and bad economies works, and how everybody doesn't like to follow the trend. In the 90s, I remember when I started that you would get this really strong employment report or something like that, and and then people worry this economy's overheating, the Fed's going to raise rates, they're going to kill off the economic boom, and the market would see these short-term corrections. Then it was obvious that the economy was still doing well, earnings were strong, and the market would go right back up to new all-time highs over and over again. And now we kind of see the opposite psychology, where people, for some reason, seem to be obsessed with the fact that there's some kind of recovery going on and things are getting better, and the Fed is going to take the punch bowl away, and they're going to stop printing money and blah, blah, blah. And I think that it's kind of just the opposite, that no, things aren't getting any better. If you look at the participation rate in the United States, the amount of people looking for work, it's at near 30-year lows, which means that the only reason the unemployment rate has gone down is because lots of people look for work. The amount of jobs being created every month can't keep pace with the amount of people entering the workforce. So things really aren't any better. We saw terrible sales from Walmart this past month. So I think what will happen is the Fed is, I think, essentially almost like talking down input costs. They know that when they talk about taking QE away, that's going to hurt commodity prices, and usually that when commodity prices are what people buy, and they want those input costs to go down. So that's kind of what I would be looking at here, that they're just talking it down. But what they're doing is the exact opposite. They're going to keep printing their $80 billion a year. They're going to keep buying MBS, mortgage-backed securities. They're going to keep buying bonds, and they're going to keep trying to juice this whole thing up.
Sure.
And what we have to realize is there's no real recovery. And like I said, I think it's the opposite, where we had this wall of worry in the 90s. Now we almost have this wall of optimism that for some reason people want to believe in instead of just looking at the facts. And the last thing is this. Everything right now in the economy in the United States is predicated on these lower interest rates. The reason that we're seeing a recovery in housing is because of low interest rates. The reason that the government can afford to spend almost 50% more money than it takes in revenue, and the deficit, being high, has not exploded to ridiculous levels, is because they have low interest rates, low interest payments. So everything's predicated on low interest rates, and it's kind of like a low interest rate bubble, and the Fed has to keep that bubble going, and the only way they can do that is keep buying bonds. And no one talks about that.
Yeah.
No one talks about, the only reason if rates go to 5%, all of a sudden you're going to have hundreds of billions of dollars more in interest payments on the U.S. debt. You're going to have, most people won't be able to afford a house. So that's why they got to keep it going as well.
Dave, we got some news this week, economic news, consumer sentiment and spending, both up, and the ISM index of factor activities up as well. Are those signs of a recovery, or is it too soon to tell?
I think, again, we're seeing these mixed numbers. Like Walmart had terrible sales. We actually had negative or flat growth in the fourth quarter. And I think one problem with all these economic indicators is, remember, one thing that they do in GDP is that government spending is factored into the GDP numbers. And what we saw in the fourth quarter is the largest decrease in military spending since, because now they pulled out of Iraq, or since they pulled out of Vietnam. And because that money got sucked out, the economy had no growth. And I think that what I'm trying to say by that is the economy's had no growth now for 4 years, but government spending, with stimulus, with the bailout, the wars, kind of made things look like they were growing faster than they are. So even though some of these indicators may firm up here and there, I still think that we're actually seeing a deceleration. ironically, I think that if we do get a tiny acceleration or growth pick up a bit, it's going to have nothing to do with what's going on domestically in the U.S. I think it's going to be more because Europe has hit bottom. And when Europe hits bottom, all of a sudden you're going to have the European economy flat and growing at 1 or 2% rather than contracting by 1 or 2%. And that is actually going to help the United States in turn. So I think actually things getting less bad in Europe in the coming months, and I actually think they will get less bad in Europe, is going to help the U.S. more than anything else.
Dave, we have some good and bad news from Europe today. The bad news first, unemployment across the Eurozone up to almost 12%, nearly 19 million unemployed. The economy in recession, that's expected to continue in the first half. The good news today, inflation at its lowest level in 2.5 years, now below the ECB's target, however they set that, at 2%. So kind of a mixed bag today from Europe.
Yeah, I think that the ECB is going to continue being very loose. Obviously, there are some definitely deflationary pressures because of the high amount of unemployed. So I don't really see the policy changing or shifting there. But again, I think what you have to realize is, look at most of these European markets, and they've corrected in the last few weeks, but they're up a lot. They're up Italy is up 50% from its lows, and sorry, now 30%. At the top, it was up about 50% from its lows. Greece had a hard rally from its lows. So I think we're looking at a consolidation in these markets. And remember, the markets are going to turn higher before the actual economy in Europe does. So remember, it's similar to 2009 when you're still in recession in the U.S. going into third and fourth quarter 2009, but the stock market had already started rallying, quite aggressively. So that's what I'm kind of looking at here. That the economic numbers from Europe are probably going to be pretty bad for the next couple of quarters, but I think the market is going to start anticipating some kind of recovery going on there.
David Skarica from AddictedToProfits.net, our guest here on This Week in Money, and we have some more downbeat economic news, this time from China. Copper and aluminum dropping to 3 months lows as manufacturing activity expands at a slower rate than the month before, and that's also affecting oil prices. They're in a funk down to below 91 today.
I think that's going to continue. In terms of Japan, they're going to have some serious problems. They're trying to devalue their way out of this recession, and I don't know if that's going to work in the short and long term, because you can't devalue into prosperity because they want to increase exports. So I think you're going to still see continued problems there. And remember, oil at 91 isn't exactly anything to say low oil prices. What's interesting is that a lot of oil demand around the world, in the United States, for example, is hitting multi-year lows, but yet we still have pretty high gasoline prices, we still have pretty high oil prices, and the reason being is what I mentioned earlier with the printing of money. You have all this money sloshing around, people can only get 2% on the government bonds, and because of that, people are going to put into other assets where they think can get returns. So they put into commodities, they put it into equities, they put it into something that they think can get better than 1-2% on a government bond on. So I'm not too worried about oil prices here. I think I don't think they're going to take off, but I definitely think we're in this kind of range of between $80 and $100, and we'll probably continue in that range in the short to intermediate term, because you have these two kind of opposite trends going against each other. Where one hand, tons of liquidity, printed money, that's inflationary. And the other one is just demand is coming down, and less demand means lower prices. So they're kind of fighting each other for the next little bit.
Let's talk about gold. Dave, it's been kind of a flat week for gold, and here's a good one. Is QE good for gold? Here's an interesting stat. Gold up almost 80% since the Fed started QE1 in 2008. So obviously it's got to be good for gold.
Yeah, I think what's going on right now in gold is that argument I talked about earlier, where this perception has become reality. Yeah. This perception that somehow things are getting better, and that is obviously gold is kind of a hedge against uncertainty or inflation. So people are acting like gold is getting better, and the economy is getting better, and that's kind of sucked the life out of gold here. Longer term, we're just in a consolidation. You look at the chart of gold. We peaked in August of 2011. We're in this consolidation of about 1520 to 1800. And I think we're going to continue on that consolidation for the next little bit. The gold stocks have acted much more poorly. But I think that gold is just in this consolidation. And I think one of the turning points, actually, we talked about these economic indicators. I think the first quarter GDP numbers aren't going to be very good as well. I think that people are going to wake up that they're going to have to keep printing at that time.
Dave, what about the seasonal aspect of gold? You and I have talked before about this, mentioning that gold stocks generally top in spring and bottom in summer. Is this going to be a typical year? Hard to tell, I guess.
Well, no, it isn't already a typical year because they generally see a rally from the fall of the previous year into the spring. And actually, the HUI, the CDNX, all the companies have fallen. So I actually think we may see the opposite.
Okay.
This has happened in the past, too, by the way. This happened in 2005, where we actually hit bottom in kind of the March to May time frame rather than topping these equities. So I actually think the opposite is going to happen. Because, again, if you look at the HUI to gold indicator and gold stocks compared to actually the underlying price of gold, they are so cheap right now. They're almost at like the 2008 crisis bottom levels.
Okay,
There's definite buys at these levels. If you're lucky enough to not be in the gold market in terms of the stocks, because they've performed poorly in the last couple of years, probably now is the time to really look at getting in.
Yeah, with Bernanke saying this week that he's not going to change the easy money policy, it seems like a good time to be getting in, right?
Yeah, like I said, I think that was a lot of lip service at the last Fed meeting when they said they're going to stop printing. I think that was to kind of take the juice out of maybe commodity markets and input costs. So yeah, that's not going to change anytime soon. I think what happens though is that in bull markets you get corrections, and then out of those corrections you get new leadership. And obviously the new leadership can be the sectors that once lagged. Like for example, Europe and emerging markets were doing very poorly till last summer, and then they led the last part of the rally in the last 6 to 8 months. And I think that's kind of what I see happening in the gold equities and commodities, that once we do see a short-term top in the stock market, and again, I don't know if we're going to start a new bear market, but at very least we'll get a 5 to 10% correction. And out of that correction, I think you'll see the commodity stocks and gold equities really lead out of that.
Dave, for folks who want to know more, who are interested in finding out about your newsletter, how can we get involved?
Well, if you're in the Toronto area on Sunday, I'm going to be speaking at the PDAC, so you get a good overview of the kind of work I do.
Okay.
And if you like what you heard here in the interview, please go to addictedtoprofits.net. I have a free list you can sign up for, and I post interviews like this one. I post some the free articles that I write from time to time. And then usually every few months or once a quarter or every 2 quarters, a couple times a year, I do a special offer where I'll tack on a couple bonus months to the newsletters. And I'm going to do such an offer in about 2 to 3 weeks. So if you sign up for the free letter, you'll get information on that when I do the offer.
David Skarica, author of The Great Super Cycle, Profit from the Coming Inflation, Tidal Wave, and Dollar Devaluation. He's online at addictedtoprofits.net. And don't forget, Sunday, if you're in the Toronto area and you don't freeze to death, check Dave out at the PDAC. More information at pdac.ca.
Oh, don't tell me that. I live in the Bahamas. It's the last thing I want to see right now.
Hey, will you be back there soon, right? Thanks for talking to us, Dave.
You take care.
Thanks to our guests, John Mauldin, John Rubino, and Dave Skarica. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.